Hey there, Brad Casser from GreatOptionTradingStrategies.com. When you think about family dysfunction on TV, on one side you have the Gallaghers and Shameless, toxic, destructive, and dark. On the other side, the Bluths in Arrested Development, where the dysfunction is funny, temporary, and oddly consequence-free. Now, when you sell options, your bad trade should be more like the Bluths. They may wobble, they may wander, but they're still easily fixed. Because hey, there's always money in the banana stand. So in today's video, I want to do another deep dive on a real-world trade we did inside the Leveraged Investing Club as part of our weekly recap series. I'm going to try to post the details and lessons learned each weekend from trades we've actually done inside the club. I love sharing the details of real-world trades because I learned long ago that just about any trade has something to teach us or reinforce in us. And the one I want to look at today involves a 300-day campaign we did on Abercrombie & Fitch. And this was also one of the 4 trades that we closed the week before last. And I referenced this trade in last week's recap video, but in that video, we focused on the textbook trade setup and entry on T. Rowe Price. Definitely worth checking out. And I put a link in the description below. But it's also just as important, if not more so, to cover the bad trades. In fact, this is where our insurance company from hell model gets to earn its stripes. As a reminder, that's how we view option selling inside the Leveraged Investing Club. Like we're running a ruthless insurance operation where we sell lots of premium and then avoid like the plague ever paying out a claim. After all, when we sell puts on a stock, and you can structure the same trade as a covered call if you prefer. I've also put a link in the description to my naked puts and covered calls for income video where I demonstrate that both trades can be structured so that they essentially produce the same outcomes and returns. But Mr. Market is basically paying us to assume the responsibility for his stock if that stock ends up tanking. And while we do theoretically agree to those terms when entering a trade, we actually have no intention of honoring those terms if anything goes wrong. We have one single objective as option sellers who view themselves as an insurance company from hell: to make money. And guess what? You don't make money when you accept or book losses. So in this video, I'll show you what that process looks like on a trade that totally went against us, and why adopting this insurance company from hell mindset yourself can dramatically change your trading results. Specifically, I'm breaking things down into 3 parts. In part 1, I'll just run through the narrative and the details of the campaign so you can see how everything unfolded. And then we'll look at a couple of key insights the Abercrombie trade has for us, especially in terms of selling options and managing an option selling trade in repair mode as efficiently as possible versus the inherent inefficiencies of something like the popular beginner strategy, the wheel. So in part 2, I want us to look at the importance of managing and repairing an underwater cash secured put or covered call for income trade by strike price rather than by break even. The wheel focuses more on break even and in the process sabotages your trades. And in part 3, we'll consider why it can make sense to convert an in-the-money short put position to a covered call. Again, not as the wheel strategy dictates where you constantly flip-flop back and forth between naked put and covered call, but for a couple of actual real structural reasons. Okay, this should be both fun and instructive, so let's get started. Okay, so this Abercrombie trade began here as a $110 short put position set to expire in just 17 days. Inside the Leveraged Investing Club, we basically trade monthly expirations until the current month's expiration gets too close, and then we switch over to the following month's cycle. That generally works out to be a 3-week to 45-day duration window, which I find to be the sweet spot that balances the higher annualized ROIs available on shorter durations where the theta decay rate is highest, with the higher amounts of total dollar payouts and greater downside protection you get with longer durations. With Abercrombie then, it was basically a 3-week trade, although we didn't actually enter it until Tuesday of that week. But our little 17-day trade here turned into a 300-day campaign. What a disaster, right? No, not at all. Especially when you consider the final walkaway returns on both a real and annualized basis. So let's look at how everything went down. We entered the trade when Abercrombie was trading at $116.25 a share, and we went with the 110 strike because the stock had recently found support near 115, and 110 looked like an even stronger support level. In this case, we should have chosen a 2-week duration because just a few days before expiration, Abercrombie broke down through both support levels. In other words, Mr. Market wanted to play. Not a big deal though. Anytime a trade goes against us, we dust off our proven and extremely effective 4-stage trade repair formula, which takes the guesswork and stress out of the trade management and repair process. And we went with a stage 1 repair, which is to roll an in-the-money short put position down and out to a lower strike for a net credit as long as we don't have to roll out more than 3 monthly expiration cycles. And that's exactly what we did. And in this case, we only had to go out 1 month. So we rolled our February 21st, 2025 110 short puts down and out to the March 21st, 2025 $100 strike for a really nice $2.35 per contract net credit. That net credit annualized to a 27.56% rate on that leg of the trade. Now in the chart here, you can see that the annualized rate on this leg ended up being a lot higher at 42.72%. That's because we didn't keep that leg open until expiration, but rolled it early to avoid assignment after earnings so that the days held went down. The point is that not only were we able to roll the short puts down a lot from 110 to 100, but that we also picked up a really sweet amount of net premium in the process. And we only had to go out 1 month to achieve this. But there's a reason for all this. There was an earnings release scheduled during the March expiration cycle, and an earnings release always injects extra premium into the impacted options. We do avoid earnings releases when setting up new trades, but if a trade is in repair mode, then we'll definitely use the earnings calendar to our advantage. Unfortunately, that earnings release was not well received, which is why we avoid earnings in the first place. Now, I'm going to go over the decision to convert the $100 short put position to a covered call position and explain the $195 strikes in the next couple of sections, but I want to continue just to wrap up the overall trade narrative first. So it was at this point that the trade really started to go against us. And over the next several months, the stock continued breaking down. Not a slow drift, but a real slide, falling all the way down into the mid to high 60s. And it would stay depressed for a while before slowly beginning to recover. By July and August, things finally started looking a little more constructive, and the stock even briefly got back above that $100 level by early August. Unfortunately, we weren't able to exit the position because there was still too much time value left on our position. Again, another earnings release was on the way. Exiting at that point would have forced us to give back a big chunk of the net premium we'd accumulated so far. And because the stock couldn't hold that $100 level, that window to exit closed on us. Now, Abercrombie did not crash and burn right away following that earnings release in August, but it did trade down. And then when you know it, another 6-week slide all the way back down to those previous lows. There were a couple of anemic rally attempts in mid-October and early November, but the stock basically just languished until the earnings release in late November when the market sentiment changed 180 on Abercrombie and the stock rocketed higher. And that's when we were finally able to exit with our full profits. And they were really good considering how much the stock traded against us. We entered the trade when Abercrombie was trading at $116.25 a share, and the stock bottomed at the very end there at $65.61 a share. That's a crazy 43.56% decline. And we walked away with 17.59% total ROI gains, or 21.41% annualized over 300 days. Now, I will admit, Mr. Market did a lot of the heavy lifting at the end as the stock just rocketed higher following that final earnings release. And we only managed to work the strike price down by $10 over the course of the campaign. So we did make a lot of progress on that front. But I just want to underscore that this is not some weird, once-in-a-lifetime, perfect storm of occurrences that somehow enabled us to pull off a miracle. This is actually just part of the process. And this is why we consider ourselves to be the insurance company from hell, because we're almost always able to repair anything Mr. Market throws at us and still walk away with decent to okay to sometimes, like this campaign, very good returns. And in this case, while the stock did come back, it didn't come back all the way. So we still generated 21.41% annualized returns on a stock that was trading about $15 a share lower at the end of the campaign than where it was when we first entered the trade. Seriously, if there's a strategy that allows you to actually make money on your bad trades, and sometimes damn good money, why would you trade any other way? I know that this sounds outrageous or like heresy or something, but if you sell options, you should not be losing money, except in very rare situations. Again, if you think this is a fluke, I posted a video over the summer making money on bad trades where I documented 4 trades earlier in the year where the underlying stocks basically fell 35 to 50% on us and we were still able to make money on them, including a couple that generated some really good returns. Okay, aside from the mind-bending reality that you can make very good returns from terrible option selling trades, what else does this campaign have to teach us? Well, that takes us to part 2. Managing an option selling trade by strike price versus break-even or cost basis. Now, one of the main reasons our returns on these repaired trades end up being as high as they are is because of how we manage them. Specifically, we manage our trades based on the strike price, not the break-even or cost basis. Don't get me wrong, we do track our break-even, but we only use that number to keep score. Basically tells us how well we're doing in our current game against Mr. Market, or as the case may be, how well he's doing against us, at least for the time being. So here's the difference. If you follow something like the wheel strategy, when a short put goes in the money, you're supposed to just wait around until you're assigned and then start selling covered calls against the assigned shares. But at what strike price? The conventional wisdom is to go with a strike price that brings in more premium, but never below your break even. And you would calculate that by deducting the amount of premium from the strike price at which you were assigned, or accumulated net premium if you've previously rolled and have more than one round of short puts under your belt. Quick example, if you're selling puts at the $100 strike price and you've collected, say, $8 a contract in accumulated net premium over 3 rounds of selling and rolling, your break-even or cost basis, if assigned, would be $92 a share, or $100 minus $8. So let's say now that the stock does trade below that $100 level and you're assigned, or rather that you allow assignment. And that's always a choice, by the way. And if you check down in the description section, I've got a couple of important resources for you on early assignment and how to avoid it and how to deal with it if it happens. The Naked Put Early Assignment Guide, which is both in video format and a more comprehensive downloadable PDF. But in any case, if you're assigned at the $100 strike price, but your break-even or cost basis is $92 a share, wheel traders are encouraged to sell or write covered calls, but to avoid doing so below that break-even and risk getting whipsawed if the stock rebounds back above the break-even price. As long as your covered call strike price is above your break-even, in this example at the $95 strike price, you can't lose money if the stock rallies. Now that's fine if you just want to get out of a trade. Managing by break-even basically means you are willing to refund Mr. Market some of the premium he's already paid you, and maybe a lot, just so you can exit the trade sooner. And who knows, maybe you're working with a high-risk stock or leveraged security and you no longer think that's a great idea and you're looking for an early exit. But it's important to fully understand the implication of selling or rolling short options at a strike price that may be above your break-even or cost basis, but still at a strike price that's below what I call the true exit strike price. And that implication is that you are willing to light some of your own money on fire. Again, there may be reasons why this might be a trade-off you're willing to make with a specific situation or trade, but it's not insurance company from hell behavior. Personally, I'm not trading in order to break even or negotiate a truce with Mr. Market. I'm here to make money on all of my trades and to maximize my returns as much as possible within the context of still maintaining safety, even with my bad trades. And maybe I should say, especially with my bad trades. So with our little example here, if you're assigned at the $100 strike price, but you have a $92 break-even or cost basis, and you sell a covered call at the $95 strike price, only to see the stock trade back above $100, you've basically just refunded Mr. Market $5 a contract at the premium you previously accumulated from those earlier rolls, or the difference between that underwater $95 covered call written on shares that you paid $100 a share for, i.e. the strike price at which you were assigned. Now, when you manage an underwater naked put or covered call position by strike price, it's a very different process and one that typically results in materially higher walk-away final returns because you're not getting whipsawed at the end. So let me introduce you to a concept I call true exit strike price. This is the original strike price you entered the trade at. It only gets lowered if you generate enough net premium on a roll or adjustment to pay for that reduction. For example, if I roll a short put down and out to a strike that is $2.50 lower, I need to bring in more for selling the new put at the lower strike than what it cost me to buy back the old put at the higher strike. That's the very definition of a net credit. My goal is to work that strike price lower by financing it with net premium. Now the accounting is pretty straightforward from the short or naked or cash secured put side, but it gets a little trickier if you switch from a naked put to a covered call, but the math is still the same. If I roll a short put down and out by $2.50 for a 50-cent credit, that's great. But if I'm holding the stock and managing the same trade as a covered call, if I roll the strike down by $2.50, I need a net credit of $3 to achieve the same mathematical result. By the way, again, if you haven't seen my video on how naked puts and covered calls are mathematically the same trade, check that out in the description below. So here's why this matters, and it's the kicker with the Abercrombie trade. If I had managed that trade by my break-even, just trying to get out above my break-even or cost basis, or risk being forced out above my break-even or cost basis, I still would have been profitable, but I would have made much, much less money. By sticking to the true exit strike price, which in this case was the $100 strike price, I protected all of the net premium I'd collected to date. And over time, that grew into quite a hefty little pile. Now, here's a key concept from the insurance company from hell mindset. And it's normally one I share as a way to explain the importance of working the strike price lower on your trade repair campaigns. But in this case, it's important just to underscore that that's how you should be viewing your strike price, as something that must be worked lower honestly and with discipline. And the concept is this: the more you legitimately work the strike price lower, the quicker you'll be out of the trade, because the less the stock has to come back. And the more net premium you collect and keep over the life of that trade, the greater your final returns and annualized returns will be. Okay, hopefully this makes sense, but if not, please let me know in the comments, because sometimes it takes a few times to fully wrap your head around an option trading concept. But remember, do you want to settle with Mr. Market, or do you want to run a ruthless and maximally profitable insurance company? And that brings us to part 3, when it can actually make sense to switch from the naked put side of things and repair an underwater trade as a covered call position instead. Part 3, the potential advantages of repairing an in-the-money cash secured put as a covered call, and cheating a little. Okay, here is where I seemingly contradict myself. In part 2, I advise you to manage an underwater trade by strike price, not by break even or cost basis. In other words, while your top priority is to work your strike price lower, you don't want to do so unless you're bringing enough new premium to pay for it. But as you can see in the trade performance table here with the Abercrombie & Fitch trade campaign, I did that twice when I sold covered calls at the $95 strike price. But I would argue that even though I did write covered calls below my true exit strike price of $100, I was still managing by strike price, not by break even, and that it made strategic sense both times. On that first $95 cheat covered call, I collected $4.20 a contract, or almost enough to fully pay for the $5 reduction in strike price. That's equivalent to a stage 1 roll down and out from 100 to 95 for an 80 cents per contract net debit. Not ideal, but I felt that if the stock traded back above $95, I could probably keep rolling the 95 covered call to recoup that 80 cents a contract deficit. And that's kind of what happened, except the outcome was even better. The stock rebounded above 95, but not too much, and I was then able to roll my $95 covered call out and up to the $100 strike price for a still very nice $2.60 per contract net credit. So I got to keep the premium from the cheat, collected another nice round of premium, and I got myself back to my true exit strike price back at the $100 strike. Now, I kept that cover call at the $100 strike for a couple of legs, but later I dipped down again to the $95 strike for the November expiration. And I did this for a couple of reasons. First, even though I only picked up $2.55 a contract of new net premium on this move, I justified going $5 lower on the strike price because of that $4.20 of premium I got away with the first time I cheated with the $95 covered call. So I can make the case that those two legs at the $95 strike, which is below my true exit strike price of $100, brought in a combined $6.75 a contract of net premium, are more than enough to cover the cost of working the strike down to 95 if I ended up being forced out at that price. So again, this is actually a form of managing by strike price, even if it is a bit nuanced. And the second reason is that I felt that even if my $95 covered call traded in the money on me, I would likely be in very good shape to repeat what I did with the first $95 covered call, which is to roll it out and up to the 100 strike for a net credit. That's because the next earnings release was scheduled for the week after my November 21st, 2025 $95 covered call position was set to expire, and the December cycle would be loaded with premium as a result. So I was confident that if my November 95 covered call traded in the money, I could use that earnings-related premium boost to roll out and up back to the $100 strike, or at the very least, roll straight out of the same $95 strike and pick up even more premium that way, and further exceed the gap between the $100 and $95 strikes. So both times I cheated by selling $95 cover calls on shares assigned at $100 a share, I asked myself what the worst case, best case, and in-between case scenarios would be. And you know what? In both instances, the worst case scenarios didn't seem that bad. In fact, they seemed easily manageable. And neither of them, in my mind at least, involved me refunding Mr. Market anything. As it turned out, I had nothing to worry about on the whipsaw front on the second $95 cover call, as the stock ended the November expiration a little below $70 a share. After the November 21st, 2025 $95 covered call easily expired worthless because the stock was more than $30 to $35 below our $100 true exit strike price, and there was an earnings release scheduled for November 25th, I simply held the shares and didn't write a new covered call. In spite of the earnings-related premium boost, there just wasn't a decent amount of premium available at either the $100 or the $95 strike price. And I didn't want to potentially sabotage the trade by selling at a strike price a lot lower than those. But this is key, and a perfect example why managing by break-even can be so self-sabotaging. Had I managed the trade by break-even, I might have been tempted to go with a significantly lower strike price because by this time we'd accumulated quite a bit of net premium to date. And that would have been an absolute disaster, and exactly why I have a problem with managing by break-even. Because as you can see in this chart, the stock absolutely blasted off like a rocket after the earnings release, and we totally would have been forced out of the trade and at a level where we most definitely were refunding a whole lot of our accumulated net premium right back to Mr. Market. Bottom line, managed by true exit strike price, not by break-even. But there may be opportunities to cheat a little by selling or rolling at strikes below that true exit strike price, where if you do get whipsawed, you're not actually refunding Mr. Market. Okay, just to wrap up, despite Abercrombie & Fitch double or triple bottoming in the mid-60s on us, the trade ended up being a great success, and we even got a little bonus windfall at the end. Because the stock actually traded back above the $100 level, and we'd held off writing a covered call, we were free to simply sell the shares back to Mr. Market at $101.80 a share and pick up some capital appreciation to further boost our final returns. Now, I'd been willing to let the stock run more, but at the first sign of stalling or weakness, I locked in our extra gains and sold the shares. Clearly, the stock got its second wind and started a brand new big move higher, but I don't regret exiting the trade when I did. The sleep at night high yield option income strategy is an income strategy after all, not a swing strategy, and so it definitely achieved its purpose. Okay, there you go. Another so-called bad trade that produced some pretty impressive market-beating returns locked in over a nice extended 300-day holding period. Long-only stock investors who entered the same trade at the same time we entered ours would have been crushed, or at least forced to hold on in frustration and anxiety and wait more than 300 days just to hopefully break even. And who knows what a mess the wheel strategy or some other mechanical approach to option trading would have made with the challenge of a situation like this. But we fully exploited the structural advantages of selling puts and covered calls, maintained our insurance company from hell mindset, kept our eye on the true exit strike price, and looked for creative opportunities to further improve the trade by cheating a little when the consequences of getting caught would be a slap on the wrist at worst. So looking back at this 300-day saga, yeah, it was messy, it was dysfunctional. At times the chart looked pretty ugly. But unlike the Gallaghers and Shameless, where every mistake leads to a darker, more toxic consequence, this trade was pure Bluth family. We had some mishaps, we had a little light treason with the strike prices, but we remained calm, trusted our proven process, and ended up having some fun along the way. And hey, how can you not love 21.46% annualized returns on a stock that drops 43.56% on you? So yet another example of why I trade the way I do and why I encourage others to adopt the same insurance company from hell mindset where it's heads we win, tails Mr. Market loses. Now, it's cool if you're okay with losing money on trades and investments, if you'd rather refund time value than keep as much of it as you can, if you'd rather surrender to a trade than repair it. But if not, if you'd like to trade in more creative and structurally advantaged ways and to do so as efficiently and effective as possible so that Mr. Market is the underdog and not you, let's stay in touch. The best way to do that is to download any of the free resources from the description section or sign up for my free daily option tips and insights newsletter in the pinned comment below. And I don't spam, I promise. And of course, subscribe to the channel if you haven't already. I love the idea of these weekly trade recaps and breakdowns. Plus, I have a ton of other option trading for income videos in the pipeline, and you're not going to want to miss those. Okay, until next time.